In this video demonstration, we'll be walking through an overview of managerial or cost accounting. Now we'll start by defining some of the differences between financial and managerial accounting. In modules 1 and 2, we were covering financial accounting in that we were covering the 3 key financial statements and calculating those financial ratios. But again, as you can see in this slide here, what we were dealing with were financial accounts that were publicly disclosed for the benefit of internal as well as external users. Whereas in the case of managerial accounting, we have access to granular detail of basically reports that support those 3 key financial statements that we evaluated, such as the trial balance or the general ledger. So we're really getting down deep into the financial reports of an organization when we're dealing with managerial accounting, and therefore we can draw deeper insights as to, again, costs, profits, etc., etc. Here you can also see that the difference in reporting is that external financial statements are audited and produced quarterly or annually, and in the case of managerial accounting statements, those are not audited and can be produced at various intervals of time, such as daily, weekly, monthly, or as needed. We covered in Module 1 the income statement, or in managerial accounting parlance, the functional income statement, in that the accounts are classified by function. Another way to look at the income statement is on a contribution basis. So in essence, accounts are classified by the behavior of the cost. Again, the examples you see here are variable, fixed, mixed, and step. We'll get into defining variable, fixed, mixed, and step in another slide here, but I wanted to show you what a contribution income statement looks like. And so here you can see a fictitious example of Schneider Coffee Inc., in which we are detailing out sales less variable costs to arrive at a contribution margin. Now recall, from the Module 1 video lecture, I had said that more or less the gross margin was a error in our financial statements texts, but in essence you can see here in managerial accounting, in essence, things change a bit from the perspective that if we take sales, which is a dollar amount, less variable costs, another dollar amount, we arrive at a contribution margin. So again, it's important here to make sure that we get that straight, even though it's a bit confusing. In managerial accounting world, our gross profit line is more or less in a contribution income statement format, the contribution margin line. So again, there, wanted to point that out. And then we subtract our fixed cost in order to arrive at a profit figure. But that's the big difference, again, between financial statement accounting, where it's functional, and managerial accounting, where it's a contribution income statement. You can see here the 4 cost patterns, and in essence, variables defined as costs that change in direct proportion to changes in volume or sales. Fixed are insensitive to those changes, and mixed have a combination of both variable and fixed cost components, whereas step is constant over specified periods of activity, but then shift higher. So you can think of it potentially even as hiring an additional employee, or in some cases, right, paying a certain wage rate at a certain level of hours, and then after that having to pay overtime rate. Here we can see the cost volume profit analysis, and in essence this is a key concept of managerial accounting, in that when we want to determine the number of units needed to break even on a profit basis, we would simply take the fixed expenses of the business and divide by the contribution margin, or as detailed out in previous slides, right, these sales less variable costs. If we wanted to determine the break-even sales in a dollar amount, well, we would also use the fixed expenses in the numerator again, and then divide by a contribution margin ratio, which is simply just the contribution margin divided by revenue. So in essence, again, it's converting the contribution margin in some ways into a contribution margin, or in a financial accounting world, right, that would be essentially our gross margin. But again, given the taxonomy and the naming of the contribution margin line for managerial accounting. It's the contribution margin ratio. So just good to remember that. In essence, if we took the break-even units level and multiplied by the unit cost or the price for each product that we sell, the revenue per unit, we could arrive at the break-even sales dollar amount as well. So we'll do that in a separate video demonstration where we walk through the break-even calculation, but wanted to at least introduce that to you here. Here you can see a graphical representation of the break-even profit graph. So in essence, this blue line at the bottom here of the graph is our fixed costs, and the gray line total cost, which would include the fixed as well as any variable expenses, and then the orange line sales. So this area down here would be where the company is losing money as costs exceed sales, and anything above that break-even point, which is approximately right around 25,000 units or $100,250 in terms of sales dollars. So that's our break-even point. When we cross over that, well, then the business is producing a profit. So in essence, again, just a graphical representation of the break-even profit. The financial managerial accounting link, I think, is critical from the standpoint that we discussed what makes managerial accounting different than financial accounting. But in essence, here is where financial and managerial link. And in essence, it's that product costing for inventory. That's the link between financial and managerial accounting. In essence, what I'm laying out here on the slide is that financial accounting accounts for inventory on the basis of raw material, work in process, and finished goods, whereas managerial or cost accounting accounts for inventory on the basis of raw materials, direct materials, and overhead. So in essence, it's just disaggregating the work in process account into three separate accounts if you see there. So in essence, again, work in process equals direct materials plus direct labor plus manufacturing overhead. That's the sole difference here. And again, I wanted to make sure that that link clear, because there are differences between the two styles of accounting, but very similar from the standpoint that managerial accounting or internal accounting reports all aggregate up to produce those external financial statements that we evaluated in the first module. Here you can see again a breakdown of those work in process inventory costs from a managerial perspective. Again, direct costs, just the cost of the raw materials, direct labor, wages earned by production employees or managers, and manufacturing overhead, all other production costs. Here you can see manufacturing overhead, and again, the first step is selecting a cost driver. So in essence, labor, which would be a much larger component, maybe perhaps in early 20th century, and as we move through time, right, automation, etc., we are now using different cost drivers such as machine hours. And so that's what you can see here in the predetermined manufacturing overhead rate per machine hour. I'm simply taking all the overhead costs from the business, predicted overhead cost, which is a dollar amount, right? And I'm dividing it by a predicted number of machine hours. And again, we can go down as far as we want, because again, we have that granular detail to assign costs on a plant-wide basis, on a department rate basis, or even do activity-based costing, which we'll discuss in a future slide. But in essence, the point here is that we're taking this predetermined manufacturing overhead rate and applying it to the number of machine hours that we're running a particular machine. Say for instance, in the coffee example, right? We're running an espresso machine, and so therefore, if we're assigning overhead costs such as utilities or rent or insurance, what have you, we can do that on the basis of machine hours. Now, maybe that's not appropriate, but again, that's the the visual or the example that I wanted to provide you, and we will be covering this in detail in a separate example video. So no worries. Again, just wanted to provide the overview here as to what manufacturing overhead is. It is basically all those costs that are associated with the product that have nothing to do with raw material or direct labor, and so therefore you can think of it as that. And how do we go about assigning that manufacturing overhead? Well, we use this predetermined manufacturing overhead rate and some kind of cost driver to assign those overhead costs, again, to the work in process of the product. Here is that activity-based costing, and the key idea here is that costs are driven by activities. So again, germane to the name, activity-based costing, one can remember this by simply saying, okay, well, activity-based costing means that there's some activity or costs that are being driven by activities. The steps that you see laid out here are that first we need to identify activity cost pools of a particular cost, and then we need to define activity cost drivers. Again, this will all become much more clear when we walk through the specific examples, but again, just wanted to walk you through a bit of an overview prior to walking through the example. Finally, we're assigning these overhead costs based on an activity-based rate. So in essence, again, very, very similar to the manufacturing overhead rate. Difference being is that instead of assigning costs on the basis of one driver, we might have multiple activities and multiple activity cost drivers. So in essence, we had multiple product lines and multiple activities. We would be assigning costs across the business and across product lines based on, again, activity cost pools, the dollars that are a part of, say, the utility pool. If that's, heat, lighting, internet access, etc., right? That would be an activity cost pool, and we would assign it to the multiple products that we produce or services that we produce. That's just an example of assigning manufacturing overhead on the basis of activity rather than on one giant predetermined manufacturing overhead rate. Now, the difference between job and process costing is that job-based costing can be thought of as a manufactured product that is unique or produced in small batches. In essence, it's bespoke. Manufacturing service businesses, and the example here again I provide for Schneider Coffee is brewing made-to-order coffee or espresso drinks. Whereas process costing might be utilized when production is confined to homogeneous product that's produced on a continuous basis. So in essence, these are manufacturing businesses. If I were, say, roasting coffee for retail sale in a grocery store, process costing would be the appropriate way to account for, at least on a managerial accounting basis. That would be the appropriate way to account for those costs versus if I were manufacturing or producing, made to order coffee or espresso drinks, well, then I'd be using a job costing method to do that. Here you can see these similarities. Basically, we're tracking under both methods, materials, labor, and overhead. And the differences, again, are that under the job cost accounting, we're basically assigning costs on a predetermined overhead rate on a job-to-job basis versus the process accounting allocates overhead on the basis of units produced during a specific time period. Here are the process costing steps in which there are two methods. We could use the average weighted method or the first in first out method. We'll primarily be covering the weighted average method, and again, this will become much more clear when we walk through specific examples, but the point remains the same. In each case, we're calculating or estimating a total cost, and then in the denominator, we're determining some kind of activity driver of sorts, or some kind of overhead driver, and in essence assigning those costs on the basis of changes in that driver, so to speak. So again, here, the process costing steps, you can see we calculate the total cost per unit via weighted average method. And to do that, we calculate equivalent units under the weighted average method. And you can see that the calculation, and then take the total cost, divide by those equivalent units to arrive at a unit material cost and a unit conversion cost. Now, the conversion cost would include both labor and the overhead. So this might be, again, something worth repeating, that the unit material cost is self-explanatory, but in fact the conversion cost, right, has not been explained yet. And so in essence, in order to convert those materials into a finished good, right, we need to add both labor and overhead. So something that I think, again, worth pointing out in this slide here. Again, you can see the two different methods, and we'll primarily be covering and concerned with the weighted average method. It's assigning costs incurred during the period over the units completed and ended units, versus the first in first out method. You can have basically two separate basically two separate costs per unit based on inventory that isn't quite complete as the start of the period. So in essence, you can think of it as computing weighted average method for period t minus 1 and period t. They each have a separate cost per unit, so to speak. And when you ship those units out to finished goods, or you transfer them out of the work in process bucket, the blended rate would be different based on the first in, first out method versus the weighted average method, which just simply assigns the same cost per unit to all units that are transferred to finished goods. So that's essentially what this slide is explaining. And that does it for the managerial accounting cost accounting overview. Look forward to walking through the managerial cost accounting examples with you, and I'll see you soon.